welcome to this afternoon's webinar from Baillie Gifford. I'm Natalie Breen from Citywire, and today I'm joined by Doug Brodie, the head of the Global Discovery Team and manager of the Edinburgh Worldwide Investment Trust. We have 20 minutes for a Q&A with Doug, and then there'll be another 25 minutes for questions from you, the audience. So please do submit them, and I'll put them to Doug at the end. As we meet now today, there's a lot going on in the world, not least with the European unrest. But there are great developments happening, from sustainable tech companies battling ocean plastics to apps that help improve teenage mental health. And we're also just days after the Axiom Space launched its first all-private astronaut mission. Despite the headlines of war and unrest, there's a lot of good in the world, underpinned by advancing and mind-blowing tech. But how do we access that? Thankfully, Doug and his team know and will talk us through some of the ways they're identifying growth companies that are shaping the future and accessing them with the EWIT. So Doug, welcome. Thank you so much for joining us this afternoon. The Trust obviously has a long history, but perhaps you can bring us up to speed with what it is you seek to achieve with the Edinburgh Worldwide Investment Trust and what your philosophy is.
Sure, thank you, and good afternoon to everyone. In many ways, the investment philosophy is very simple. We seek to invest in companies that are out there solving very big problems, very big pressing problems that often have a global relevance. So really companies looking to reshape their industries through that application of innovation and human ingenuity to build what we think are great companies. And I guess the diversity of that problem solving really comes through when we think about the portfolio. So this is companies looking to solve how we treat disease, how we buy product, how we write software code. But there is a real sort of commonality of ambition and build businesses for the future. So I'd probably encourage your viewers to think about almost the solutions to those problems as intrinsically being better, cheaper ways of doing things. And if companies can achieve both those ambitions, they tend to really become unstoppable. So the challenge for us is really to sit on what we think are the frontiers where we will find those companies. We think to do that well, you have to look early for these companies. For us, the proxy for that is go small in the sense of stock markets. So a lot of people would look at what we do and think we're smaller company investors, but we would probably intrinsically think we're more growth investors. We're just applying that to the most relevant part of the market. And in doing that, we hope to find these businesses that'll genuinely shape the world on a 10 to 20 year view.
So you say that you're predominantly a growth investor. How hard is it, though, being a growth manager in today's market?
Sure. Investing is never easy. I think a lot of people with sort of rose-tinted spectacles that would think about, businesses like, isn't it obvious that Amazon existed because we needed an e-commerce champion, or Google because we needed a search engine? And they often just sort of forget about the uncertainty that these businesses, these hugely successful businesses, would have had to navigate to get to where they are. And I think, uncertainty is a key component of investing, managing it, dealing with it, handling periods of volatility and price instability like we've really got at the moment. They test your temperament as an investor. They cause you to test and refine your investment philosophy. They tend to, I would argue, actually make you a better investor and iron out any sort of crinkles in your processes. You learn a lot about your companies too, to see your companies under periods of, perhaps operational difficulty. Not everything grows in a nice linear fashion, particularly when you come down the market cap scale. The reality is investing is a fundamentally long-term driven task, and it's bookended more by the patience that you apply to it than it is from sort of any event to any other event. And I think about my own career. I started in this industry back in 2001, in the week of September 11. So it was quite a sort of strange time to come into finance, and the world of finance began running money in 2006. A couple of years ahead of the financial crisis. So I've sort of seen periods of quite extreme exogenous shocks and geopolitical shocks, and in many ways the pattern of those can be quite similar. Uncertainty all of a sudden pops up. People's time horizons condense down. People bring in their time horizons, how they think about businesses, and if anything, that's maybe become a little bit more extreme as those years have gone by. It's been, I think, for a lot of investors, particularly growth investors, it's been quite a bruising year. I think that needs to be seen in a sort of longer term context around how we think about our businesses and how we think about our portfolios. So in that way, I'd encourage you always to think about the long-term track record of a fund or an investment trust.
So you've been obviously, as you said, managing money since 2006, but you've been on this investment trust since 2014 in particular. How has the trust evolved since you took over? Has the kind of philosophy stayed constant? And how's your temperament as a growth investor at the moment?
Yeah. Well, I mean, just to sort of caveat it, EWIT's history goes back a long way before me and a long way before Baillie Gifford's involvement with it, all the way back to sort of 1896. I guess the sort of modern age of EWIT began sort of 2003. That's when Baillie Gifford took on the mandate. It was run as a global growth portfolio. And I sort of inherited that mandate, as you say, in 2014. And we sort of refocused it on that opportunity lower down the market capitalization scale. And we were aware of lots of sort of dynamics that were at play there. There was a real sort of, I would argue, there's still a sort of golden age of technology and innovation that was coming through. And many of the dynamics that were underpinning that essentially allowed companies to scale faster, to capitalize on opportunities faster. And in the old sort of physical world, that was quite hard for small companies to do. But with digital ways of scaling, they could do that a lot easier. Crucially, we structured the portfolio from that 2014 point to, look for small ideas, but actually have the ambition to own very large, successful companies as those businesses that we bought when they're small, when they deliver, when they grow, and when they thrive. So that's really been a constant ever since we took on the portfolio. Look small, but have the ambition to own very large, successful companies. We think that's a genuine differentiator in terms of many other smaller companies' funds.
So I would like to get into the process of how you identify some of these exciting companies and look at some of the examples, because they really are fascinating and, as I said up front, kind of mind-blowing for us as civilians. But first, can you touch a little bit on your research process and how you manage that with your team? I guess particularly how you've managed that, in kind of recent history. You're not able to jet off to Silicon Valley or Asia, or not even really able to go into your office in central Edinburgh. How have you been managing to still, touch base with these companies and find new ones as well?
Yeah, sure. I mean, I think the whole, not just Baillie Gifford, the whole industry, both on the sort of the corporate side and on the investment side, had to adapt to elements of that. And, you think about the skills of what investment is. It's fundamentally a research-based task. You immerse yourself in the task of finding these companies and adhering to the investment philosophy that you sort of stick to and work to. So that's sort of the initial nugget that gets you interested in something. Occasionally that can be because you physically stumble upon a company in a different part of the world. More often than not, it's more a sort of academic pursuit of joining up tangents while sat in front of a laptop, speaking to people, engaging with one company that sets off a seed of thought that pushes you down some avenue, engaging with colleagues that sort of help you elaborate and build on that thought. So a lot of the sort of the bones of how we do investing actually adapted very well to a sort of digital environment. Now, there's maybe that element of going deeper and, increasing your understanding of a business. And I would argue that's where the sort of going and sort of feeling the companies, understanding, maybe the layer of management below the typical managers that you would meet of a business, seeing how a company acts on the ground, and just, engaging over a longer period of time with those businesses. So, that's what we're all desperate to get back to. It's nice to get back into the office and sort of do more of that physical interaction with your colleagues and bounce ideas. But in many ways, the core task didn't change. The pace at which we come up with ideas didn't suddenly drop off a cliff. If anything, it maintained itself in that sort of environment that we all had to wrestle with for 2 years or so.
Yeah, I suppose you're getting some time back, in between meetings. You're not having to schlep from one airport to the other. You've got time in front of your laptop.
Yeah, but don't get me wrong, I'm looking forward to getting back on a plane.
Sure, let it be a holiday first. So let's dive in and talk a little bit about some of the companies that have been recent contributors to performance. Which ones have been standing out for you recently?
Yeah, sure. I mean, we run sort of north of 100 companies in the portfolio at any one time. So there's always lots of companies that some doing better, some doing worse than what we would expect. But if you think about the last sort of 12 months or so, some of the key standouts, one would actually be one of our longer term healthcare positions that we've held for I think over a decade, a business called Alnylam, a Boston-based biotech, the dominant force in an area called gene silencing. So this is using targeted drugs that act at the genetic level to go after diseases with pinpoint precision, and effectively taking that huge body of genetic insight that science is unlocking and making that directly relevant and druggable. So we first invested in that company when they were just going into clinical trials, and now they've got multiple drugs on market and a pipeline that's really increasing massively in its ambition because they've proven that the platform that comes up with their drugs. So going into big areas of cardiovascular disease, Alzheimer's disease is very much on their radar as well. So we've known that one for some time, but I've become hugely enthusiastic as we've seen that one develop. A business called Shockwave was also one of a very positive contributor in that sort of 12, 24-month period. They do miniaturized sonic-based devices that you insert into a catheter into the bloodstream of a patient to basically go after plaques in the blood, plaques in the vessel wall, and destroy them with a sound sonic-based procedure. So for very meaningful impacts on sort of late-stage cardiovascular patients. And Tesla's been a long-term holding and has actually been a very positive contributor over that time period, as well as production scales and the business really just begins to hit sort of proper economies of scale. And I would argue their lead in electric vehicles is as strong as it's ever been, if not stronger.
So then what have been the detractors perhaps to performance, and why? As you said, the path to success in young companies never runs straight, and I guess you've got to be pretty patient. Which ones have been detracting so far?
Yeah, I mean, there's been a theme of a sort of constant derating of growth over that past 12-month period that's been quite strong. So businesses like Ocado, like Teladoc, almost stocks that the stock market would look at and go, they were classic winners in a pandemic environment. Grocery, e-commerce, telemedicine, they were natural winners. And those businesses have been very heavily derated in that current environment. And I'd almost say that that's independent of any sort of stock-specific reasons. And we actually think those businesses have progressed strategically very strongly in that time. We've had a couple of businesses, as you always do, where operationally it's been a little bit more stock specific. One that was quite painful for us would be a business called Zillow, a bit like the right move, but of the US market. And they had very ambitious plans to with a product around Zillow offers, where they effectively didn't operate just as a marketplace, but they took ownership of homes and then tried to disaggregate housing chains. And in the end, a few operational missteps, in a difficult environment, that proved to be quite a challenge too far. So they backed off that, and the stock market had concerns around that. I think we actually think that everything they built in that time to really push out that offering, it can be monetized in very interesting other ways. So still hugely enthused by that business itself.
In terms of structure for the trust, you recently increased the ability to invest in unlisted companies. What percentage is it that you're able to invest into now, and why was that change so important to you and the team?
Yeah, we recently asked for permission to get that maximum level raised to 25% from a 15% level. We were getting close to that 15%, so it felt that a sort of practical, it was beginning to be a practical constraint on our appetite, and we kept finding interesting unlisted businesses. I'd almost sort of think about that unlisted opportunity in sort of two senses. There's one aspect where it basically makes us, I would argue, better investors. We are more informed. We don't just view our universe as listed businesses and go, unlisted companies, we can't buy them, so we don't care. You need to be very informed about everything that's going on in the areas, particularly when you have an investment style like ours. It gives you that fuller picture. And almost the secondary reason for doing it is you get to access themes and businesses that you just could not do in the listed sphere, certainly in such a pure way. So, in many ways, the way in which that we discussed earlier on, in terms of how we think about businesses and how we do that research, that's kind of ambivalent as to whether or not that's applied in a private company context or a listed company context. There are differences around how you maybe get introduced to those businesses, how you do the legal due diligence, et cetera, but the analytical part is actually very similar. So it's a natural extension of what we do. It allows us to invest in businesses like SpaceX, really transforming the economics of space travel, building out the Starlink constellation, north of 2,000 satellites now in building that out. It allows us to access businesses like PsiQuantum, doing optics-based quantum computing and making some really terrific progress at doing that in an intrinsically a much simpler way than others are pursuing on quantum computing approaches. Our first business that we invested in on the unlisted side was a business called Oxford Nanopore, which is now migrated to being a listed business. So we've owned that one since, I think, 2015. So it's a great way for us to build relationships with these companies, really understand them and watch them through their formative stages, and then own them and potentially in time introduce other colleagues in Baillie Gifford to them as well.
What are the associated risks then? I guess both in terms of your strategy overall, but in particular when investing into unlisted companies.
Well, in many ways, the fundamental risk of investing is permanent loss of capital through investing in businesses that just fail to deliver. That you'd say that's kind of universal across the listed sphere or the private sphere. We are big believers in investment asymmetry, both at the individual company level and possibly more importantly at the portfolio level. Just that ability to invest in companies where you can make multiple times your investment. And when we've seen that with companies like Tesla, with businesses like Dexcom that we've owned. So I think we've got great credentials at doing that, but almost like the flip side of that is you do have to sort of kiss some frogs to find the princes. That is just the nature of that. And you have to have, as a team, as a collective of people, as an institution, you have to have a tolerance of doing that. You have to have a sort of no blame culture. You have to take sort of team ownership of these ideas. And, I think that's something that we do very well. It's not pleasant when companies go wrong, but you can't let the fear of that happening stop you from investing, or you'd never get the upside of investing in businesses that end up doing phenomenally well.
Yeah, I guess you're always at the risk of either kind of bringing yourself down from being excited about a company so that you don't get too carried away, but then also not suffering the lows too greatly either.
Yeah, and you learn from the businesses that don't work. You refine it. Now, it's not as simple as I invested in company X and I'll never invest in a company that looks like company X again. But there are patterns around how these businesses try and scale and why sometimes that fails. And you learn from that and you incorporate that into your process.
I read you wrote, I think, in one of your blogs about the great pride you felt when SpaceX first launched one of its missions, and it was kind of a team celebration. You must get, what other companies have you had that sort of feeling of pride, team pride with since that?
I kind of touched on it earlier, but the one where personally I'm sort of most proud to have seen the progress would be Oxford Nanopore. That's one that we've seen all the way from basically sort of scientific publications postulating that you could sequence DNA and analyze genetic material in a certain way, all the way through to working that up, building that up into devices, and now deploying that at scale, really to push the application of genomics and genetic insight into areas where it's just not been applicable, either from a sort of form factor perspective, an ease of use perspective, or potentially even a cost perspective as well. So Yeah, there'll be lots of examples of that, but personally, that's the one that shines the most with me.
So a scientist in you is most excited about it.
Yeah, scientist / geek, that might be the way.
To the audience, we're going to turn to audience Q&A in a moment, so please do submit any questions that you have. But Doug, before we turn to audience questions, let's talk a little bit about ESG and your approach here. How do you balance ESG when investing in fledgling companies? Is ESG at the forefront of their mind, or is it something that just kind of happens as par for the course? Where do the companies that you invest in stand on ESG in their approach?
Yeah, I think... as a long-term investor, I think we've always been mindful of sustainability and ESG type concepts. Now, it's more overtly sort of labeled as that now, but as a long-term investor, the clear measure of success for our companies is their ability to grow and ultimately generate profits on the back of that. And I think, it's not just the case that building out profits and growing a profit stream is a simple sort of accounting concept that then translates into a rising share price. There's so many inputs and variables across multiple stakeholders that goes into a profit stream and the sustainability of that profit stream. So you have to be in tune with so many of the aspects that feed into that. I think that there's, as this has sort of risen up the agenda, rightly so, there's now a lot more data points that you can hold sort of companies and fund managers accountable to in terms of how the companies operate that they're investing in. Now, I would argue a lot of that sort of maybe the best practice around that is just sort of extrapolated from large businesses and forced upon smaller companies, probably at earlier stages of their development. And sometimes you almost want governance practices that are more fit for purpose for a stage of development rather than sort of gold-plated best practice. But maybe the bigger aspect for us is, I would say, so much of the ESG narrative is about how companies operate in the here and now, how they behave, what they do, what's their current situation around governance. There's maybe a more forward-looking aspect that I think shines through very neatly with our companies in that they are trying to build things and solve big fundamental problems. There's a future-looking aspect around building a world that is fundamentally better, more efficient, and ultimately more sustainable. And maybe that's always been a little bit of the ESG narrative that's been missing for me. So I'd argue that that's more a sort of a growth investor's take on ESG than a sort of smaller company investor's take, but I still think it's a very relevant point.
Let's turn to some of the questions that we've received from the audience here. So starting at a sort of geographic level, we've got a question here that says, would you look into frontier markets for the right companies, or is it mostly European and US centric?
We set the team up. We aspired to own businesses that had a global relevance to what they do. Now, there's a reason for that, in the sense that if you define your opportunity set as global, you have the most sort of blue sky potential to grow into. You can find a lot of innovative entrepreneurial businesses that can be pointed in a very regional context. And sometimes, that region may be big enough, particularly if it's the US or China, that you can still make a very attractive business out of it. But the minute you start getting into frontier markets, it's much harder to find innovative entrepreneurial companies that, in any sense of a medium to long-term time frame, can make a valid claim to becoming globally relevant businesses. Now, I hope and genuinely hope that many of them in time could make that transition, but that sort of aspiration to own companies that think and operate globally is really quite key to what we do.
Following on from that to an extent, we've got a question about China in specific. It says here, how significant have regulatory changes in China been to the portfolio?
We have a number of holdings in China, a relatively small number, across a whole host of different industries, from sort of healthcare, drug development to online gaming, to aspects of internet and e-commerce. Now, I would say some of the regulatory sort of moves that we've seen in China have been quite pointed at certain sectors. Online gaming actually would be one of them. There's maybe also sort of equal positive regulatory noises coming out, arguably in terms of some of the healthcare moves and a desire to have more sort of China-based R&D and sort of local domestic champions around that side. So look, I think it's difficult to speak about that as sort of general comments because the points where they've targeted it have been, I would say, quite pinpoint in what they've gone after. And in some ways, it's difficult to argue with that they're coming at it with quite a noble ambition, stopping kids playing so much time on online games. As a father, I can slightly empathise with that.
Yeah, kind of as I said at the beginning, we're developing apps to help teenagers with their mental health, so that the two need to go in tandem, I suppose. Let's look at a portfolio level here. We've got a question that asks, has there been much portfolio activity? Are there any companies that you've sold recently and why? I guess you sort of touched on that, but if we could go into a little bit more detail, that would be good.
Yeah, I don't have the data to hand in terms of portfolio turnover, but roughly over the last sort of 2 to 3 years, we've hovered around that sort of 10 to 15% per annum turnover. So consistent with a sort of 8 to 10 year investment time horizon. If people have followed the performance of the investment trust, or indeed the Global Discovery OIC, which I also run, they will know that in the pandemic, the early years of the pandemic, we had a phenomenal period of outperformance, and then more recently that's been marked by a period of underperformance. In a way, that's the kind of the stock market oscillating around us than it is us, rejigging the portfolio. We didn't reposition the portfolio because we thought there was a pandemic coming, or even when we saw there was a pandemic, we didn't change what we do. So, you stick to your causes for owning things. We have moved on from a number of names. We've actually had a few companies taken off our hands through M&A, a business called Cloudera, we said goodbye to fairly recently. Probably one of the most, if I think about sort of a stock that we've owned through a life cycle that we've now moved on from, a good example of that would be a business called Dexcom. We owned, Dexcom does continuous blood glucose monitoring. For diabetic patients, helps them dose their insulin. We'd owned that from sort of very early stages of its commercial traction to a point where we'd done very well out of that as investors in the business, and we looked forward and projected out where we thought the opportunity could get to. And for us, it felt like a case of good news was in the price, effectively.
Great. We've got another question here that says, do you think the market has become too focused on the short-term macro environment? I guess we kind of talked about that a little bit up front. And they go on to say, do you think we've lost perspective of the fundamental reasons for investing in a company?
Yeah, I definitely echo quite a lot with that last point. Look, stock markets don't exist fundamentally for people to express views around GDP growth, interest rates, inflation. Now, they've emerged as a sort of route for people to try and do that with a sort of shorter term trading mentality. And, you can't, I don't think you can stop that. That's not fundamentally why stock markets exist. Stock markets exist to provide capital and liquidity to people that have great ideas and need capital to develop those ideas. And the quid pro quo from that is that society gets to share in the net benefit of those ideas. So there's a sort of higher level reason as to why equity markets need to exist. And I think that that higher level reason is much more in tune with the sort of long-term investing time horizon. Now, every so often you have these exogenous shocks where most of the time stock markets do an okay balance of short-term versus long-term, but the minute some exogenous shock comes along, the uncertainty component rises markedly. People don't like uncertainty. People like to think that the future is predictable, even though they kind of know it's not. But the way to make you think it is predictable is to project out the next 2 weeks, the next 3 months, the next 6 months, and trick yourself into thinking that it's predictable. And I think an awful lot of investors in current markets, fall into that category. Now, it's not to say that the world hasn't gone through a difficult period the last couple of years. You've got a world and a sort of business world and commerce world that's trying to emerge from a couple of years of hibernation. You've got clear inflationary shocks. You've got an interest rate environment that people are trying to understand how that's going to look for the next decade. You've had all the troubles in the Ukraine and Eastern Europe that in many ways sort of further emphasises some of the inflation trends, etc. So look, it's difficult to sit here and say that the backdrop from, say, consumption or consumer activity hasn't deteriorated a bit. It would almost be naive to say that, but that's not, that's a time horizon argument. And most of the businesses that we invest in, their future will be determined by their own actions, the actions of basically the quality of the products and the services that they generate. That they're more about trying to drive a mix shift or a fundamental a change in the way that people consume the product of that industry. That they're not at the mercy as much of the big macro trends. But people tend to look at smaller companies as the most exposed to a sort of cyclical economic shock, and intuitively, I've never understood that.
How do you pick through all of that noise then? How do you wade through kind of fears of inflation to find those standout ideas?
You employ genuinely curious people, and you preach the philosophy to them, and you get them thinking around, well, what are the areas of the world that will change the most? And when I say areas, I don't mean geographic areas, but what are the tools and the technologies that are out there for companies and entrepreneurs to explore with? So at any one time, there's probably just numerous frontiers where there's interesting stuff going on. You want the people on the team to get out there and almost sort of position themselves on those frontiers. Don't go in with any sort of preconceived ideas, but just go and explore that frontier. Who's doing the interesting stuff? Who are the thought leaders in that field? There probably will be some companies that are on that frontier. Get to know them, get to meet them, work out who is doing the most interesting stuff. That's what we do and how we sort of build up these relationships with the companies. It's the most rewarding aspect around what we do as investors. And I say that's a constant in all that we do.
You need curious minds to find the trends.
Genuine, authentic curiosity and a desire to understand how things work. I think that for me, that would probably be it.
Let's turn back to some audience questions here. We have one saying, you seem to run the portfolio without allowing any one stock in particular to become too large a proportion of the whole. So what would you do if SpaceX or PsiQuantum got materially revalued?
So it's a question more about stock exposure of the unlisted things if one of them was to run away. Like I guess we have the ability on the listed side if something was to get up to 10%, then typically for us that's been the point at which we might go from a portfolio diversification perspective. Do we want to recycle some of that capital back into other ideas? There's nothing intuitively that could stop us going through 10%, but maybe the challenge at that point would be if you had two or three things get up to that sort of level, then arguably there is too much of the portfolio in one specific area. With the unlisted stuff, you don't certainly easily have the ability to sell or reduce these positions. I think roughly speaking, SpaceX is sort of 3-4% of the portfolio at the moment. So it would have to be a very material uplift for it to get to those sorts of levels where historically we've done something. But yes, it's not to say that won't happen. There probably isn't. There's always an element with the unlisted businesses that they probably are at a slightly earlier stage of their development and of their commercial progress. So there's maybe less of an argument about recycling capital from them because they are still, very obviously immature in terms of where they could get to.
We've got quite a few questions on that vein, but about Tesla in particular. One saying, given Tesla's market cap, do you think it's still appropriate for EWIT? And do you have a size when you typically sell?
It's probably the most distinctive thing about what we did when we set up the team and the portfolios that we now run is we were adamant about not having a market capitalization-based trigger as a sort of forced discipline to exit something. I'd historically run regional smaller companies' money and, proper small cap allocations where if things did cross a market cap limit, you got a phone call from somewhere saying, this business is working, you've now got to sell it. And frankly, there's nothing that's more frustrating around a sort of process point as that. And think about how we've then sort of positioned the philosophy of EWIT. It's to find these businesses that can go on and become genuine global titans at what they do. Now, there's maybe a debate around Tesla valuation versus Tesla stage of immaturity. You're generally talking here about a business that's sort of low single-digit market share in terms of global automotive productions. So on that hand, I would still argue it's compared to the transition that we're going through from combustion engines to electric vehicles, the share shift hasn't happened and the market share battle hasn't been won. And that's still very much Tesla gunning for that one. So in that way, it's size for us, it's more a proxy, a pretty poor proxy for the immaturity of these businesses versus where they could ultimately get to. And that's the real nugget of why we wanted to avoid it as a sort of mandated sell point.
But then I guess you have the limits in terms of the size of the company when you invest. Am I correct in saying that?
Yeah, we commit EWIT to typically being below $5 billion at time of investment. And again, that's to sort of keep us honest to that philosophy of look small but aspire to own large. We're not going to try and sneak Amazon into the portfolio and argue it's an immature business. So it's more keep us true to what we do. But, I would really encourage viewers to think about what we do as growth investing, just applied to the most relevant part of the market where growth is probably easier to access. Growth starts from a lower base, and you can find companies that can have multiple decades of growth ahead of them.
Super. I think we've got time for a few more questions. So let me squeeze a couple more in here. So biotech exposure has had a significant and of late painful exposure. Do you see sentiment towards the sector shifting?
It's sometimes difficult to generalize because there is not a typical biotech stock. There are businesses at multiple stages, all the way through from preclinical biotechs to companies in the clinic trying to get their drugs through trials, through to businesses like Alnylam, which have got drugs on the market and are trying to push forward a pipeline. So almost you've been through a bruising period in biotech where the earlier and the less proven you are, the more brutal stock markets have been to you. There's often a funding risk element with biotechs. They have to clear the next hurdle. Drug development is expensive. You have to clear the next hurdle from a sort of progress or clinical perspective to almost unlock the ability or willingness of investors to fund the next stage of the business. So as you've come through a sort of pretty brutal stock market sell-off in more overtly risk-based assets, it's not unexpected to think that the funding environment for biotech has become, I would say, a little bit more challenging.
Let's look at the energy sector quickly before we close and ask, how does Baillie Gifford see the energy sector transitioning? Is hydrogen the future?
Yeah, I can give my views on that. I'd hesitate to say they're Baillie Gifford's views, but it's there's clear momentum now around the decarbonisation of many big industries. And if you look at in detail at how that can happen for many of the bigger, historically more polluting industries, hydrogen feels like the most obvious route for them to decarbonise. And by that, I'm talking aspects of aviation, aspects of sort of steel refining, big heavy industry. If it's other industries, maybe batteries and electric vehicles are the answer. But big industrial processes, Hydrogen stands out for me in terms of being a key sort of decarbonisation route for those areas. Now, hydrogen in and of itself is actually currently a very big industry. It's just that most of it isn't produced in a sort of green capacity. Most of it actually originates from hydrocarbons. So there's a huge opportunity just initially to take existing uses of hydrogen, make them green, decarbonise lots of aspects around that. Longer term, the bit that really intrigues me would be as you get more renewables being the origin of power, the harvesting of power. What is your ability to store that in a long-term sense? Renewables have either seasonal patterns or weather patterns to them. They need to have a corresponding duration of storage, and it's difficult to see batteries being the long-term answer to that. You need a longer-term storage medium, and hydrogen is very interesting in that capacity. So we've done a lot of work recently on electrolyzers, on fuel cells. We have a long-standing position in the trust in a business called Ceres Power, doing very interesting fuel cell developments and then looking to get into electrolyzers. And more recently, we have taken a holding in ITM, doing industrial scale electrolyzers, basically taking electricity and making hydrogen.
So just to close then, we've got a question here saying, can you give us your outlook for the 3 most important themes to your overall holdings? Nice one to close on. Your outlook for 2022 and beyond.
I can pick a few. I mean, it's one, we're bottom-up stock investors, so the themes are shaped by the ideas that we unearth. But one would be aspects of digitization in healthcare. I think that, be it all the way from telemedicine to video games that can embed therapeutic content in them. We have a business that we own, a business called Achille, which does that for treatment of ADHD, all the way through to companies like Novacure using clever medtech devices to treat brain cancer and potentially cancers beyond that. That would be a clear theme. There's been a strand that's emerged recently. Well, I guess we've touched on the hydrogen one, so I'm not going to use that one again. Around software tools that help businesses scale. Often software tools that are sold to software developers. Businesses like Appian that we've owned for a couple of years now. A more recent holding would be JFrog. That helps sort of companies push out software and applications developments much faster in a seamless way. Again, a long-standing theme in that sort of healthcare area, but look, healthcare is sort of 40% or so of what we own in the trust. Just that sort of application of genomics is a very broad theme, all the way from sort of diagnostics that can either pinpoint diseases very precisely and very accurately, through to, as I've touched on with Alnylam, therapies that operate at the genetic level, all the way through to understanding sort of predictive factors around risk and potentially guiding you through the course of your life how to minimize risk based on genetic factors. We're in the foothills of where that could ultimately get to, and that's a very prominent theme in the fund. So yeah, I've touched on a few there, but I just emphasize that all those themes, they come from the companies that we unearth, and the companies set the tone for the themes, not us.
Doug, I'm afraid that's all we've got time for. Thank you so much for your insight and your comments on the Edinburgh Worldwide Investment Trust. And thank you to you, the audience, for watching and for all of your questions. We have many more sessions like this coming up, so do keep an eye out for more from Baillie Gifford. But for today, that's all from me and all from Doug. Goodbye.